Hello, I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll dig through the latest building consents data from Statistics New Zealand, which show new house building at record lows. We'll also look again at the monoline bond insurance crisis and explain what it might mean for the global financial system and for interest rates and exchange rates here. Firstly, we begin literally at home with housing consents data for December, and they make disheartening reading because just when New Zealand needs new houses built to improve supply and affordability, these figures show consents for new houses hit a record low in December. The data reinforces evidence the housing sector is in recession and will please the Reserve Bank in its fight with inflation. But it does mean improvements in housing supply and affordability are some way off. Consents for 1,524 buildings, now that excludes apartments, were issued in December. That was down 28% from November and down 14% from December a year ago. It was also the lowest monthly figure since April 2005. Now that month was badly affected by the introduction of new building regulations. Apart from that bureaucratic hiccup, it was the lowest month since February 2002 and the lowest December since 2001, 7 years ago. Apartment consents rebounded in December from a collapse in November, and overall dwelling unit consents were down in December too. The numbers tally with anecdotal evidence of a slowdown in new house building activity and with signs that house prices generally are falling. Developers have in many cases been sitting on land banks or are unable to use land on the fringes of major cities because of planning restrictions. This means the ability of house builders to add supply to the market and therefore improve the affordability of new houses. Now let's get back to the so-called monoline bond insurance crisis. Before you ask why bother with such an arcane subject, it's worth explaining why it matters. This one's been bubbling away beneath the surface of the global credit crunch disaster for several weeks now, and the signs look ominous that it could burst out into the open and trigger a new round of turmoil on global financial markets. And whenever that happens globally, two things happen to us here. Firstly, the global appetite for risk drops, and therefore the appetite for our risky carry trade currency drops. And secondly, in theory, interest rates globally fall as investors flee to the quality of government bonds. But interestingly, risky bonds and some New Zealand wholesale bond rates have been rising in the last 6 months as the spread to government bonds, which measures the risk appetite for investors globally, actually widens. So, further global financial turmoil could mean a lower New Zealand dollar and higher interest rates. But first, what is this monoline bond insurance crisis all about? Now, way back in the day when investors were buying bonds and bond-type investments willy-nilly, they would often insure themselves against losses on those bonds by buying credit default swaps. Now, the insurers selling this type of insurance are known as monoline insurers or bond insurers. When the markets were relaxed, these bond insurers managed to get AAA ratings from the likes of Standard & Poor's and Moody's. But now the subprime crisis has struck and the bond insurers have taken big losses because some of the bonds defaulted. That means the ratings agencies are thinking of downgrading those AAA ratings. The biggest of these bond insurers are called AMBAC and MBIA. Now, I hadn't heard of them either until now. But remember those names, because they could easily be household names in a very bad way before too long. Unless AMBAC and MBIA can raise a significant amount of cash to bolster their balance sheets, then Standard & Poor's and Moody's are widely thought to be about to cut those precious AAA credit ratings. And if that happens, all hell will break loose. That's because all the banks will have to cut the value of all the AAA bonds they hold that are insured by AMBAC and MBIA. They hold over $2 trillion of these bonds. Now, estimates vary, but most expect this would force the banks to book losses of anything between 100 billion US and 200 billion US. That's around twice as much as they've booked for the subprime disaster, which has caused all this turmoil so far. Right now, New York's insurance regulator and Governor Elliot Spitzer, you remember him from all those Enron prosecutions, they're desperately trying to arrange a bailout of these bond insurers before they are downgraded. Now, Bloomberg reported last night that time is running out and a rescue package is unlikely before the ratings downgrade bomb hits. We'll keep an eye on this one. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you tomorrow.